Good morning, everybody. It is FOMC day, May 7th, and we're going to get started on our prep for today for the equity indices, gold and oil. First, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Now, to start off today, we're just going to take a look at our overall dashboard here, and we can see where things are in relation. The right side is the high end of its scale. The left side is the low end. The same thing that you see on the website with our bands. We can just monitor all our instruments, including our Mag 7 stocks plus Netflix here and see where they are. So we can see Tesla's coming down to the low end of its range at the moment. Amazon as well is at its lower rotational zones. So that would be a buy signal likely at the open as the market is opening gap up. But we'll cover some of those levels here this morning. Big one, gold. We mentioned yesterday that we would look for that upside move, and we made our move towards that all-time high that we had laid out. We had an all-time closing high yesterday. We're still looking for that all-time high push again, but our top end of our range and expectations and where market makers are, all that positioning is saying that we are likely coming to that top, and that would have been your sell. So we told you to get in down around that 300 down that lower rotational band at that 3303, 3290 area for a nice 120, 150 points if you're able to swing it. So if you're day trading it again, then you have different strategies, but we cover that in our courses with our students. So for today, some of the things we want to look at on the ES, and this will translate as well to the NASDAQ as they are very similar. There's a few differences though. We are below our line in the sand on the ES. We are right at it, pushing up to it. So that tells us again, smaller price action. When we broke below all of our lines in the sand, we were looking for cleaner price action to the downside. We did get that. Now we're looking for that more likely smaller range, and that makes sense when you think of FOMC today. That we'll see the range expansion in the afternoon. So that's what we would look for now. Yesterday, if we want to go back first and look at what happened on the ES and the SPX, we mentioned to you that we were lacking the insurance and we would look for that downward pressure. So yesterday, when we opened in the morning, we pushed lower. We pushed up at 9:30 to 56.33 and then all the way back down to 56.07, filled the gap, and that was on that insurance buying. So everybody buys the insurance. We see that. So we moved from our uninsured range down here in the green to our red zone, which tells us that all of that insurance buying is done. And now we can look for the market to turn. And sure enough, the market bottomed. And at 10:04, we rallied from 56.08 to 56.70. So that is that sell insurance at a high premium, push the market up, premiums go away, people lose money. That was all that protection for Bessent speaking, for all the Trump speeches yesterday with Carney. And we see that insurance play. So when we look at where we are in terms of insurance today, we are just under our red zone. So that tells us again to look for that downward pressure. Now it's not as much as yesterday, so we have a little less usability, and we know that the timing of this is not likely to be at the open, more so in the afternoon. So it could be at the open if people really want to try to buy insurance, and we would look for downward pressure as that brings those premiums up. Just like if we're getting a storm or you get into a car accident, your premiums go up. That's what we're seeing is people will pay for higher premiums as they need to protect capital in the markets, and then that would dampen some of the volatility that we expect. And again, on overall asset volatility, we are still trending up and holding over 20 on the VIX. So that tells us all we need to know on where the risks actually lie. We want to pay attention here as when we see our volatility rising or we see these volatility premiums and discounts coming in, you can see that since the beginning of April, we've really had a more of a discounting mechanism, and that has we had premiums rising, and then once we bottomed at the beginning of April, we've seen that premium for that volatility coming down, and we've seen the returns then pushing higher. We saw this back in 2022 multiple times, and what we want to be mindful of is if the premiums for those insurance policies begin to rise again, that's going to bring more downside returns. So the returns are in the red here. The premium or discount is in the blue, and you can see when we're at a discount, we typically go up. When we're at a premium, we typically will go down, but then we also need to look at the slope of that to see how it's shifting as time goes. So um, there is still a lot of risk in the market, and that's what we're seeing. We're coming right down to our zero line, and that's what we're going to watch for to see if that changes. Then we'll look for a sustained rally up to that 200-day moving average, where a lot of algorithms will be programmed and people will be watching. Otherwise, if we see our blue start to tick back higher, then we're looking for that downside and likely breaking 5,600, headed back to 5,150. From our positioning standpoint, our systematics are still very under invested overall. We are in the 10 to 20% range in overall exposure. So they have a lot of capital when you're talking a 600 plus $1 billion system, a lot of capital on the sidelines. And that is likely we're going to see another big buy on Friday of 20 plus $1 billion coming in, but that's still going to leave them at 21% invested overall. So they're adding a very large percentage and in terms of notional and nominal values, but that still is putting them overall very low investment compared to where they typically are. To give you a comparison, back when we were making all-time highs down here, we were at around 98 to 100% invested. All the capital has been flushed out. And then when we think of fund managers and mutual funds, again, we are only about half invested, and that's a multi-trillion dollar strategy. So our systems, we're about 60%, 50 to 60% invested. That peaked at 99.24, meaning almost all cash was invested right ahead of FOMC in December. And we will see at times where they buy on margin. That didn't happen. That happened back in July ahead of the rate decision by the Bank of Japan and a little bit of the unwind on the carry trade. But when we look at our systematics as well, both of these strategies have gone from nearly fully invested at the top to a large amount of capital on the sidelines. So that's where, when we think of our COT reports and our data that we have for you all on our website there, here's the S&P, and you can see it. Commercials went net long. So they were short this whole way up as we had all this strategies buying on, full cash and some on margin. And then the liquidation of all of that capital, they started buying, and now they're selling into that. And you can see they're selling as the last couple of weeks we've gone down in that exposure. So they bought at the bottom and they're selling on this move up. So again, follow your flows and understand what's happening on the business side of the market, because these are billions and trillions of dollars. If unless you're part of that group, which I am not, and most of our traders are not, as we are day traders and individual retail traders. We want to be following these so we can piggyback off of it. And so this is what's happening in the market, and we know where these points lie. Now, in terms of levels for today on the S&P, we are looking for more rotational price action, basically between 56.20 and 56.90. Round that out to 5,600 and 5,700 if you'd like, but we are more rotational to get a little more precise there, 56.20 to 56.90. And our line in the sand is at 56.61. So that is where things would change. We're likely going to stay around that and try to get over that ahead of FOMC to dampen the risk that the market makers face. On the upper end of our range, we are looking at 57.32 to 55, and on the lower end, 55.80 to 57. Now, when Powell does begin to speak, we're likely going to see an expansion on those ranges. That is always something that's in the cards when he speaks. We get a lot of outsized moves, especially when they do the rate decision at 2 o'clock, but really 2:30 for the dot plot and the forward guidance for June's meeting. That's when we see the bigger moves. So that's what we're going to be watching for much more closely. And then on to the NASDAQ, as many of you prefer to trade a little more volatile instrument. We are looking today at rotational price action from 20,158 to 19,830. And we are over our line in the sand. You can see that horizontal line right here, that pink line right here. That is our line in the sand for now. And that is below all of our expected ranges. So even if we go down, that is going to dampen things until we break that. So that's at 19. Uh, so the major line in the sand is 19,366 here on the futures. And so we will be watching that closely. Our lower end of our range is 19,567. So even with range expansion, that's still 200 points above our line in the sand. So we're not likely going to change today. Uh, on the upper end, 24.21 and 23.22 are your targets. So again, expecting that rotational price action, 158 to 19,830. And if we get over 158, then we'll target the 300 area. Some other key levels for you on the NASDAQ today. 20,217 quarter, 19,787, 19,740, and 19,617 is our last major bid. On to oil, we mentioned earlier this week that $55 was going to be key. We mentioned that when we tested it in April, that's where Saudi Arabia typically steps in. They've pushed out the narrative that they won't step in and support, but either they or somebody did when we pulled back to 55.30. So we were looking for that rotational move up to 59. We made that. Now we've retested that line in the sand here. As you can see on oil, here's our line in the sand, that pink horizontal line. We retested that yesterday and compressing into it in the overnight. We are looking again, rotational price action 59.91 to 57.73. If we get over that 91, you are looking for 61 to 61.66. Staying under 91, we'll look for a reversion back to 57.73. If we break that lower end, then we're looking 56.64 to 55.99. And remember, oil is a proxy for geopolitical risk. So with what happened last night between India and Pakistan, that is something that is also going to continue to push up those oil prices just on the off chance that people want to hedge for any type of geopolitical risk in terms of further escalation. Other key levels for you today on oil, 63.07, 59.94, and 58.04. Those are going to be three other key levels that you might want to pay attention to. And lastly, on to gold. We've done very well on this on our own trading, and hopefully you guys are capitalizing as well. We held the rotational high yesterday and continued upside towards that new all-time high, and we did make an all-time closing high. So today we are looking rotational price action 34.10 to 33.20. And our upper targets are 34.83, which would be a new all-time high, and 34.56. So staying over that rotational high, we look for continuation. If on FOMC we do see a liquidation in gold and profit taking, we would look for 32.76 to 32.49. Other key levels to pay attention to outside of just the bands that we have here for you: 34.31, 33.65 3/4, 33.54 quarter, and 32.67. Those would all be your bigger areas to pay attention to on gold. And as always, guys, make sure to control your risk today, especially. Remember that at 2 o'clock, we get the rate statement. At 2:30, we get Powell speaking. And before that, we have Bessent at 10 o'clock continuing his testimony. And then there's always the off chance that POTUS is going to tweet something or decide to have an impromptu press conference that is unscheduled, calling out the Fed or their rate decisions. And so we are looking for a heightened volatility environment. And that's what we'll be paying attention to this afternoon. You guys, again, just control your risk. That's the number one thing that we can control in this game. And the better we control that, the longer we can survive, and then the more profitable we can be long term because you don't want to have to bow out because you've lost all your capital. So be sure to control your risk today, and we will be back again tomorrow. Have a great day, everybody.